Hey guys, welcome back. In this video, we are talking about the unwinding of swaps, the aggressive AMC moves, the short-term target of $10, and many more in this video. Now, first we're taking a look at this. So UBS stake has been reduced to 0, which would be the unwinding of client swap contracts. So we've seen that UBS has sold their shares in AMC. Now, the thing about this is we talked about how all the timing of this is too coincidental. Now, firstly, we're looking at how the unwind of these big short positions is being orchestrated by banks, market makers, and hedge funds to defuse an infinite AMC short squeeze. 31.8 million shares UBS held, which cost around 60 to 95 million. They were bought when AMC was at $2 to $3. They dropped AMC to all-time low to get UBS the cheapest exit possible. So the reason why we talked about the timing of this was recently we've seen how UBS were hit with tons of margin requirements. They were required by the regulations to increase their margins, or they were very likely to get margin called. Now, that itself has already told us about the positions they were in, about some of the stocks and swaps that they hold were becoming too toxic where it could easily liquidate the bank. And what we then saw was how they started buying AMC shares. And as soon as they met the requirements, as soon as the timeline, the deadline came, they were suddenly able to not talk about the margin requirements and then all of a sudden dump all of their AMC shares. So once again, to me, it looks like the reason why they were buying these AMC shares was because they needed the counterparty towards all of these toxic AMC swaps that when it blows up, it was going to put them to bankruptcy. And so it isn't to say that now that they got out of all of these positions that these swaps become meaningless, is that finally they're not being kind of bit on the back by the regulations, but the fact that we saw the recent drop on AMC was so that they could get out of this. Again, it goes on to talk about how still institutions are working amongst themselves to help one another, but it talks about how even a big institutions like UBS needs the help of others to make sure that they don't get liquidated, to make sure that they don't get margin called. And so that is still a very big thing. Now we can see about here, it looks like the theories have been confirmed as we see the 31 million shares being removed, and it looks like that Adam Aaron's target all along was to talk about companies like UBS where they inherited these positions. And again, maybe UBS got wind of what was going to happen because we see companies like Discovery, Pentwater, BlackRock all coming together to buy tons of shares of AMC to potentially orchestrate the short squeeze on AMC. And again, the ones who are going to be hit the most would be institutions like this. There is still, of course, a lot of talks in the back. This is something that we obviously don't have access to, but if you are someone who knows more of this, make sure you comment down below. But I do think that right now we are at a standpoint where institutions are finally viewing this situation as any time possible AMC can go off. So they're trying to do anything they can to increase the margin requirements to offset their positions. But for the ones who are stuck in this too deep, they obviously can't get out, and we've seen it from this. Because another reason for this is that we know that UBS not only inherited the AMC toxic positions, but they also have the GME toxic positions. And coming from this, what we have was this. Why would the NSCC and OCC publish this and tell brokers they're on their own when it comes to GME warrant transactions? So this is what we're seeing right now. On top of what's happening with AMC, they look like they're talking about GME as well, where they will no longer accept the GME warrant for settlement, and it's down to the brokers on their own. And I think that this is also a big signal as well. When we talk about the lack of liquidity, we're obviously aiming in at the shares of AMC and GME, where brokers aren't able to actually find shares, where settlement facilities are also lacking the ability to. And now it looks like with the GME warrants, they are finding the same struggle. So they're trying to leave these problems to the brokers. And there's been examples of this before, but I wanted to highlight this because it shows that both AMC and GME suddenly are seeing liquidity issues, and then UBS, the one who has inherited both positions. Now, there are, of course, other companies out there, but ones we know with definite data of inheriting these toxic swaps is, of course, UBS. And now, as we see AMC and GME in this position, suddenly UBS is struggling. The reason why I say this is because of things like this. Now, we've already talked about MMTLP in the past before, but I think it's important to bring it up again as we talk about the lack of shares allocation for AMC and GME, where we talked about how for MMTLP, NextBridge investor claims to hold more shares than TradeStation appears to have allocated for the dividend distribution. So according to the press release, TradeStation was allocated 406 shares for dividend distribution, with one NextBridge share issued for every 30 TLP shares held. So that would imply that the allocation corresponds to approximately 12,180 shares. This one investor says that TradeStation owes them 600 shares as part of the distribution, but TradeStation only has 406 shares to distribute. So this isn't the first time where we've seen brokers coming in at a lack of allocation for shares. We've seen brokers have these problems before. Now, of course, the ones that will be the worst would be the settlement facilities to not have shares, and that's why they're dumping their problems onto these brokers, because evidently we've seen brokers like this to issue out synthetic shares, to not have the allocation of shares, but yet nothing major has happened to them. And it looks like they just want to kick the can further down the road once again as they leave these problems to the brokers. But this to us is just another big indication of everything that's going on. It's a proof of everything that we've said with how the real shares have been held by the apes. The shares that you're seeing floating around on the market, 9 out of 10 are synthetic shares, maybe even more than that. And so this is how we know that everything is going to crumble. And then on top of all of this, suddenly you're also seeing how market liquidity appears to be declining. Now, the timing of this is once again very, very interesting. At the very start, we talked about how UBS were required to increase their margin. One of the biggest reasons for this was because their positions are getting too big to handle. And as we see this, market liquidity is declining. And this is just the showcase of why we've said these firms who are making it out to be in record profit, who are making it out as if they're doing the best in this current condition, not just talking about UBS, but plenty of other short institutions that involved AMC as well, they are all not as good as what they're making it out to be. And we've seen firms who talk about record profit, record revenue, yet they need to take up more loans. We're seeing firms where they are talking about there is no need for margin requirements, yet the market is saying otherwise, yet the institutions are saying otherwise. And this is just the showcase. And the big thing about this is just that the overall collateral is going to be declining, because we talked about how the liquidity ultimately is how they were able to suppress AMC in the first place. They use the liquidity in collaterals they have in other places. We talked about this with the Mag 7 stocks. We talked about this with the AI stocks. We talked about this with crypto. And as we see the liquidity declining, you're going to be seeing the collaterals declining as well. And the big part in terms of how we are playing to this, and you can see here, retail investors are selling US tech stocks at a record pace, where we've sold 316 million of US listed information technology stocks on Wednesday. Now, a big thing for this is that 360 million may not sound a lot in comparison to potentially the 300 billion you're seeing, the 3 trillion derivative position you're seeing. However, ultimately you have to understand is that we are no longer giving our collaterals for these big institutions, and because the best emphasis on here is tech stocks. Retail is not just leaving the stock market. Retail is leaving certain tech stocks and going into other safe havens, going to other investments where it proves to have deep value and has a big potential, aka AMC, aka GME, and of course many others as well that you guys have invested in. But this is playing the big part, because by us selling, even though it's 316 million, you have to remember the effect that this would have. This would obviously cause a further decline in the stock. We may have only sold 316 million, but the effect on that is in the billions. And so these institutions are now losing their collateral value in the billions. More importantly, they're losing the retail money, and that's what they're afraid of the most, because that's what they've been trying to make money from the retail. And as we leave from the tech stocks and go into stocks like AMC, that's when they're panicking, because we have already set up such a strong foundation. When you talk about who's the biggest investors within AMC, it's retail investors. And who has kind of the most of the majority shares, who has the real shares, once again, it's the apes, it's the retail investors. And so these institutions are trying to scramble for shares for AMC, and it's what we're seeing. Now, in terms of this post, I want to talk about my opinion, but I do think it's an interesting read. So he talks about how I expect AMC to make some really aggressive moves up in the months ahead. Now, I completely agree with this, because when you take a look at everything we just talked about and everything we've seen in the past, all of this are indicators indicating to AMC going up. The reason why I say this, and we can break it down, is that firstly, when we talk about the fundamentals of AMC, you've already seen how well we've done for Q2, and you're seeing how well the box office is doing now. So going in for Q3, we're going to get even bigger. Going into Q4, we're going to get even bigger. And so that's already inflecting in terms of the money that's flowing into AMC, in terms of people who want to buy AMC. But on top of this, we then have what we just talked about earlier, the liquidity failing in other areas, and these shorts won't have the ability to manipulate AMC as much as possible. So essentially, all the conditions required for AMC to go up right now are all being ticked off. And that itself is obviously a very good thing, and it's why I'm expecting aggressive moves. Now, the part I want to talk about and why I disagree is this user then goes on to talk about how, however, it's not a squeeze move. The mechanics for a squeeze are largely gone thanks to massive dilution, huge float, lots of easy access, and cheap borrow fee for shorts. Now, this is where I disagree, but I want to make it very clear is that this isn't a hate towards this particular user. Like we've said, we always have to look at this objectively. There will be people with different opinions. We have to be as non-biased as possible to understand our strengths and weaknesses and to really understand where AMC is at. So this isn't me telling you to go onto this guy's page and talk about anything. This is just me giving my opinion. I hope it helps you guys. So he talks about how the mechanics or the possibility of a squeeze is gone because of dilutions. And the reason why I disagree with this is that we've already talked about and acknowledged the dilution. We talked about how, yes, dilution does have a negative impact, but we talked about how the benefit outweighs the negatives. But another thing for this is that we talk about and we understand that there are billions of AMC shares that have been created. We don't have an exact number, but you've seen from data how it can easily go from 5 billion synthetic shares all the way up to 50 or even more billions of synthetic shares. And so AMC diluted, and they've diluted around 200 to 300 million shares now, with a further potential 200 million more, because we talked about how they increased their authorized shares by 550 million. So that's how much dilution in the max that we are going to see. Now, even if they were to fully offer 550 million shares and all of these shares were to go to the short, it still doesn't mean that the mechanics of a squeeze is gone, because the reason for a squeeze now isn't the same as before. The reason for a squeeze now is because there are billions of synthetic shares. So 550 million, while it is a large amount of shares, it isn't going to put a dent within the 5 billion, 10 billion, 50 billion synthetic shares that are being made, because 550 million and you subtract that into the 50 billion, there is still 49.5 billion synthetic shares left. That is the reason for why we understand there is going to be a squeeze. Now, in terms of easy access and cheap borrow fee for shorts, we just talked about the illiquidity for AMC shares. So to talk about easy access is clearly not that case. There is no easy access. And to talk about the cheap borrow fees for shorts, well, evidently it doesn't look like it's cheap. And if anything, it looks like it's very lucrative because there are so many institutions who want to buy shares to lend it out because they know how much money they're able to make from those. That's why I agree with this. Again, I agree with the aggressive moves, but I disagree with the fact that there is no chance of dilution, because I do think that there are other perspectives that you have to put into consideration from what he has obviously mentioned. Once again, this is no hate. We're just giving our own opinions on this subject. And if you take a look at this right now, AMC has closed very strong for the Friday, and it looks like that people were expecting good news because we were seeing the amount of shares that were being bought in the final 15 minutes. And with Spider-Man being released, it looks like we are going to get another massive box office, potentially a new record to being broken, a historical box office weekend. And this is what we talked about with how AMC is only going to be issuing out better earnings quarter by quarter, months by months, years by years, and that's why people are expecting to do well. And remember, because Spider-Man isn't in IMAX, Spider-Man flogs to the other premium screens such as Dolby, where AMC has nearly 100% of the screens. So if you're going to talk about who's going to benefit the most from this, it's of course AMC. And so when we talk about how well the AMC fundamentals is going to be, this is what we're looking at. And in terms of the short-term price target, what we can see right now is that AMC Technicals is doing very well. Now, one of the things that we talked about for technical analysis on AMC is that because there is so much manipulation, you can't take it with the same way you potentially do technical analysis on other areas. However, it is still a very good signal. Now, as far as the option goes, it goes to $10. But Adam Aaron has been signaling a different loads of price targets where he talks about the number 6 a lot, and previously we talked about he was really hinting at $75. So potentially the short-term target is that we're seeing it go to $6. Then once it breaks 10, that's where the option goes. All of the gamma exposure comes in, it goes all the way to 75. This is still obviously all up in the air, but I do believe that there is a big potential with this, and we are really looking at this turnaround, this pivotal moment for AMC right now. As always, this is F Financial Advice, and I'll catch you guys next time.